Hello, everyone. My name is Janine Donnelly. I'm the manager of webinars for Independent Banker Magazine. And on behalf of ICBA and Independent Banker, I'd like to welcome you to our presentation. We will be holding a Q&A session at the end of the webinar. You may ask a question at any time during the event by entering it into the Q&A panel. If you experience technical difficulties during the webinar, please use the Q&A panel to alert us, and someone will assist you. You may download a PDF version of the slide deck today by clicking on the drop-down menu labeled Event Resources, and you'll find that on the left side of your screen. And know that you can download the slides right from the platform without being disconnected from the webinar. Today's webinar, Reciprocal Deposits Are Growing, Navigating the New Regulatory Environment, is sponsored by Reich and Tang Deposit Solutions. Our featured speaker today is Tom Nelson, Executive Vice President and Chief Investment Officer. Tom is responsible for overseeing the firm's FDIC-insured programs, sales growth strategy, and product development initiatives. Tom is a frequent industry speaker throughout the bank, trust, and brokerage spaces, discussing the impact of regulatory changes in the short-term markets, bank funding, and FDIC-insured investment strategies from a growth and profitability perspective. So without further ado, Tom, I'll turn the presentation over to you.
Thank you very much, Jean, and thank you very much to everybody that's joined us today. I hope you find this beneficial. And just one follow-up to what Janine was saying, please feel free to ask questions. I will try to answer them as I go along, or in some cases it makes more sense just to do them at the end. But one way or another, we'll do our best to get everybody's questions answered. So as Janine indicated, what we're going to talk about today are reciprocal deposits and the use of reciprocal deposits now primarily with a significant change in the regulatory environment, and how these deposits are things that could make sense for a lot of different banks. And quite frankly, I want to run through what these products are, how they work, and how they can be beneficial to firms. I just want to start with an introduction of our firm, make sure everybody understands who we are, our history as a firm, as well as in this space. We are one of the market leaders in FDIC-insured bank sweep programs. We provide services to banks, broker-dealers, trust and investment managers, RIAs, and a variety of other entities. Our focus is solely on working through intermediaries such as those. We do not do any direct-to-market activities, so you never have to worry about our firm being a competitor to your firm. We have been in existence since 1974. We focus and have always focused on deposit and liquidity products, different cash management solutions. We've run both FDIC programs as well as money funds over time, but our roots are clearly in the short, high-quality fixed income space. We provide strategic on-balance sheet liquidity programs for banks of all sizes. We provide more than $50 billion worth of funding to banks now. But more important than the funding, we help banks achieve their balance sheet needs and customer needs. Unlike, I think we're one of the few firms in the space where what we can say is our expertise is not only in banking products. We have a wide depth of experience in banking products, but we also have a tremendous amount of experience in asset management, capital markets as well. Asset management and capital markets as well. Which gives us, I think, a unique view into how these products are often used by the customers, the kinds of products our intermediaries need to sell these products against. We have tremendous understanding there, and obviously we are a thought leader and educator on reciprocal deposit on all bank kinds of deposits, but we worked very hard to have the legislation that we're going to talk about today passed, Senate Bill 2155. We've also been very involved in money market reform, Basel III, and other things that have broad and wide implications to financial intermediaries, as well as the cash markets. So today, what I'd really like to focus on is talking about the financial reform bill from last year and the impact that it has on banks specifically, again, as we're talking about reciprocal deposits. Now, this bill, Senate 2155, best known as the Crapo bill, the sponsor of the bill, had very, very strong bipartisan support. It focused on consumer protections, regulatory relief for community banks. It was focused much more towards community banks than large banks. They provide them with some regulatory relief, given some of the legislation that had occurred beyond the financial crisis. So you can see here from the list, this has everything to do with mortgages and student loans and veteran protections and regulatory requirements for bank holding companies, et cetera, et cetera. This is a bill that touches almost every bank in the country and touches just about every bank in a lot of different ways. We are going to focus today on one of those changes, which is the which is Section 202. Excuse me. Section 202 discusses the classification of reciprocal deposits and has really been the first official stamp of approval, so to speak, from a government body about reciprocal deposits. And in addition to being a stamp of approval, so to speak, I think that's probably a stretch of a statement, but it also changed the way officially reciprocal deposits needed to be treated by the FDIC. Prior to this bill, reciprocal deposits and the funds that banks took back from these programs had to be classified as brokered, regardless of how the bank acquired those deposits. So you could have core depositors with a couple of $1 million. You put them in the program to get FDIC insurance. The money you took back had to be classified as brokered. That was obviously a problem for a large number of banks. It limited not only whether they could use these programs, but the amount that they could use in these programs. This bill specifically stated that a bank can treat up to 20% of their assets or $5 billion, whichever is less, as non-brokered. So a $2 billion bank now has the ability to place $400 million in reciprocal deposits and treat them as core. It doesn't have any effect on their brokered holdings, and it's obviously a much more attractive way for banks to get funding. It provides smaller banks with a tool to compete against the SIFI banks. It levels the credit playing field. It gives these banks the ability to go after larger customers, provide FDIC insurance in a way that doesn't harm their balance sheet, and gives them the ability to compete against ever larger banks. So smaller banks can compete against mid-market banks. Mid-market and large banks can compete against the bulge brackets and so forth and so on. It's a very much of a credit leveling type of a product where you're providing large amounts of FDIC insurance regardless of the size of your bank. And most importantly for banks, it allows these deposits to now become a stable, long-term part of their funding strategies, and allows these banks to continue to take these deposits even if they fall to adequately capitalized. One of the issues prior to this bill is that adequately capitalized banks without a waiver could not take brokered deposits. Since the deposits that were taken back in reciprocal programs were brokered, those types of reciprocal deposits became difficult for a lot of banks to use because of the what-if scenario. If they became adequately capitalized, what would they do? They'd be forced to lose these deposits. It would be a significant issue in some cases. And a lot of banks, again, steered clear of this because from a regulatory perspective, it was problematic if they failed to adequately capitalize that they could no longer use these products. That's all changed. Banks that are adequately capitalized can continue to use these programs, and that's another major change based upon this bill. So I wanted to start at the beginning, talk about what an FDIC insured cash program is, which is part of what a reciprocal deposit is, make sure that people understand how these programs work, how our program can provide assistance to banks. And it's pretty simple. You have a customer that has more than $250,000 that either wants or needs. Now, I'll talk about this in terms of both wants and needs. Some customers need FDIC insurance. Some customers just want FDIC insurance. But it really doesn't matter. Either way, you have a client where one way or another you need to provide them FDIC insurance above $250,000. What is simply done is any amount over 250 or a different number, it could be, is taken from the intermediary bank, from you, given into the program. We then take those deposits, whether it's $1 million, $10 million, $25 million, whatever the number is, and we allocate that money out to banks in increments of $250,000 or less. So if you have a client with $10 million, you give us the $10 million, we allocate that money to 40 banks in increments of $250,000. You have a customer that has a $10 million deposit that's fully FDIC insured. Then, all of the banks all of the other banks in the program have customers that are doing the exact same thing. We allocate money back to your bank in increments of $250,000 from all of the customers of all of the other banks in the program. So what ends up happening, depending upon how the program is used, you can put in $100 million of customer money and take out $100 million of customer money. But from a customer perspective, they have a liquid deposit that's placed with a variety of banks in increments of less than $250,000. What I often say is that this is no different than what retirees around the country have been doing for years, which is finding the highest yielding banks, whether it's CDs, whether it's money market accounts, and placing no more than $250,000 in a specific bank to make sure that their money is FDIC insured at all times. We do the same thing that retirees do it. We just do it on behalf of millions of end tax IDs. Now, with these programs, customers will have access to their cash on a daily basis. There is no term to these programs. There is no, locking up of deposits. Everything is done all of the deposits are placed into either a DDA or an MMDA, so your customer has access to its funds every single day without fail. And your customer you will remain the interface with your customer at all times. The customer is not going to call us. The customer is not going to work with us. The customer is going to be working with you. You are our customer, and your customer is your customer. We don't want to get in the middle of that relationship. So the demand deposit marketplace, how does it work? There are three distinct ways. I will talk through the first two relatively quickly and then get to reciprocal. But there are three distinct ways that a customer can use this program. And when I say customer, it's not only you, but it's your customers as well. This program can be used as what we describe as a send-only program. That is where you take customers of your bank, put money into the program, but do not take funds back out of the program. You will do that because you are deposit heavy, loan light, and you simply don't need these deposits at a given time. but you don't want to get rid of the customers. You don't want to, pay the customers, quote, a punitive rate because you are not in need of funding at a specific time. You want to maintain the customer relationship, but not necessarily maintain the customer deposits. You put the money into the program. You have the ability to earn fee income because we will pay you a rate for those deposits. And then whatever rate you pay your customer, the difference between what we pay you and what you pay the customer, you can keep as fee income. It increases the overall competitiveness of the offerings that you can make to your client, and regardless of your balance sheet needs, regardless of your deposit needs at a given time, you can still satisfy the relationship requirements of a specific customer. Now, the program can also be used in a receive-only basis, so this would be the exact opposite situation where your bank is deposit light, loan heavy. You need money, and you don't necessarily have customers that are crying out for FDIC insurance beyond the standard insurance levels, or because you have a significant amount of collateral that's not being used, or whatever the reason is. You just need deposits. We provide, for every dollar that is sent into the program, we obviously have to have a bank that is willing to take that dollar. So if for every send-only dollar that goes into the program, there is a corresponding receive-only dollar going to a bank. So we can help banks that are both, have too many deposits and too few deposits. The deposits that you would take back in a situation of receive-only will be priced very attractively, priced against short-term funding rates, and will be liquid for you. So these are not deposits that you have to lock up for years or 6 months or whatever time frame it is. You have the ability to dial these deposits up and down to help satisfy the needs of your balance sheet at a given time. Now, the biggest increase in the way that we see banks using the program, specifically based upon the regulation, is reciprocal deposits. Now, I've talked a little bit about how reciprocal deposits work, but just to be clear, when your customer money goes in and goes out to other banks, the same amount of money comes back to you, unless you don't want the same amount of money to come back to you. So you might be in a situation, for instance, where you have $100 million worth of customer money coming into the program. We allocate that $100 million out to banks based on each tax ID, each customer coming into your bank to make sure it's fully insured, at all times. But then we turn around and give you some number less than $100 million. So you might be, not in need from a balance sheet perspective to take $100 million back at all times. Maybe you only want to take $75 million back. We have the ability to move that amount very flexibly so that you can take back the amount of deposits you need. In doing so, you don't have to change anything with your client. The agreements that you have with the clients are about sending money into our program. It's not about sending money back to you. So you don't have clients that are receive only, that are send only, and you have to make some kind of change with the client in order to reciprocate the deposits. Those changes are made directly with us. Your clients are unaffected by any changes that you need to make in the amount of funding that you want to take at a given time. So what are the benefits of a reciprocal program? Clearly, since this change in legislation, the demand within the bank space has been almost unilaterally around reciprocal deposits. Reciprocal deposits with reciprocal minus, in there, where a bank might put 100 in, as I said, and take 75 out. But one way or another, the demand now is clearly around reciprocal deposits. So why? Well, as we indicated, the biggest issue is the fact that these are now core deposits. That if the customer, when I say that these are core deposits, just one clarifying statement there. If the deposits you get are from a core customer, if they came into the bank core, they will remain core. Nothing we do will turn a core deposit into a broker deposit. And one quick question. I had a question here asking if we can send in more. I've talked about reciprocity, about the ability to, put in 100 and take out 75. With the program, with the receive-only options we have, you can also put 100 million in and take 125 million out. That can go either way. The only issue with taking more deposits out of the program is that's based upon availability. We will always allow you to go from 100 to 75 or 75 to 100 if that's the amount that you're putting into the program. We'll always allow you to go up to 100% in reciprocity. But we won't guarantee more than 100%, but that will be done on a best efforts basis. So, here's the key, that with DDM, banks have the ability to throttle up and down the amount of deposits they're taking. So you don't have to go out and win a client relationship and worry about, do I want the money 6 months from now? Do I want the money 12 months from now? Or I really don't even want the money now. You can put those customers into the program and feel comfortable that at any point in the future, when you want to lower or raise the amount of deposits you're taking, that you can do that directly with us. That is one of the biggest attractions for a bank's balance sheet of these programs, is that you're not locked into that municipal customer that has 50 million, whatever the number is, 50 million, 25 million, $10 million with you. You're not locked into that customer if your balance sheet is in a position where you don't want money. You can offload that money to us. There are always banks around the country that are looking for money, and we act as a middleman to get money from banks that don't need it to banks that do need it. One of the other key program benefits of this program is that you will control the rate that you pay to your customers at all times. So we'll get to this later, but the rates are normally that we pay you for send-only money, for money that's just coming in from your customers, is going to be around Fed funds over time. If you have a customer that you can pay 50 basis points to, your cost of funding, if you reciprocate those deposits, your cost of funding will be 50 basis points plus our fee. Our fee is 10 basis points. Your cost of funding would be 60 basis points. If you have to pay your customer 150 basis points, your all-in cost of funding would be 160 basis points. You can go as high or as low as you want with that rate. You control it. You do what's best for the firm. You control the rates that you pay to your clients. Simple slide. Want to make sure that it's clear that you can turn the reciprocity up and turn the reciprocity down at any time. Now, can you call us at 4 o'clock and say that you want to go from 100 million to 0? No, you can't. But on a daily basis, you will have the ability to go from 100 to 80, 80 to 60. We need those calls earlier in the day. This is not meant to replace a Fed funds type of a program, Fed funds sold or bought program, but over time you'll be able to go up and down. And we have customers that regularly will go up and down once or twice a month to take the reciprocity from 100% down to some other number. Now, one of the questions we're often asked, and one of the things that I think is very important, is what kind of customers can use a program like this? And the answer is any type of a customer that you can open up an account for. So remember, at the end of the day, all of the money is being placed in MMDA and DDA accounts. Right, so as long as you can open up an account for a client on your books in a DDA or an MMDA, you will be able to place those funds into the program. So here I've listed a variety of customers. Municipalities are probably the biggest single customer type, I should say, that uses the program, largely because municipalities, as a general statement, either need collateralization or FDIC insurance. So for them, as a general statement, FDIC insurance or collateral is a requirement. It's a need, not a want. For most of the other customers, unless they're indenture issues or investing issues, it's usually a want as opposed to a need. Need being from a regulatory perspective, not necessarily need being from a document perspective. So these are deposits that can be used in basically in all types of accounts. So as we look at the use of the program, one of the things that becomes critical is that this is a program that makes sense for your end customers, right? In order for you to get the funding, this has to be something that is sensible for your end customer to use. And I think as you look at why does anybody place money with any type of investment, there are three things that they need to look at. They need to look at credit, they need to look at liquidity, and they need to look at yield, right? So this is a program that needs to satisfy those three basic requirements, or it doesn't make sense for an investor to use this. So from a credit perspective, it's fully FDIC insured. Now, we can all quibble about what is the best credit available in the market today. I think FDIC insurance, if it's not the best, it's awfully close. Certainly better than a lot of the other options that any customer has. And unlike a situation prior to these programs, you can take a client that's got $10 million and fully insure them. So instead of having $250,000 in insurance, these programs give them $10 million. So from a credit perspective, our argument is that these are as strong a program as you possibly can have. These are very attractive for customers to use because they're fully FDIC insured. Customers have the ability to opt out of banks. You have the ability to opt out of banks. So if a customer is doing business with a bank across the street, heaven forbid, they can say, I don't want any of my money deposited at that bank, to make sure that they never have duplicate insurance. So from a credit perspective, this is as good a product as you can offer to your client. Liquidity. All of our money is in checking accounts, all of our or savings account. So we all know what the liquidity associated with checking and savings account is. Every dollar is on call every day without restrictions. They can make as many redemptions from our account as they want. They are not limited to six withdrawals. They can make as many withdrawals as they need to in the course of their normal business. No money is ever placed into CDs, so there's no restriction on customer liquidity. The program, depending upon how you access it, can be provide liquidity as late as 3:15 Eastern Standard Time. In a few rare occurrences, we can go slightly later than 3:15. We'd have to talk about those on a one-off basis. But think about it that you can have daily liquidity for your customers for excess FDIC insurance and have daily liquidity up until 3:15. And most importantly, from a liquidity perspective, liquidity is always at $1. This is a checking account. This is a savings account. This is not a security. This is not an investment. It's never going to be worth anything other than 100 cents on the dollar. And from a yield perspective, so from a send-only perspective, current rate is 238. It's Fed funds less a few basis points. Really very attractive as compared to any of the money fund indices. But more importantly, you get to set the rate in a reciprocal program that you end up paying to your end client. So if 270 is the right number, if you're in a high rate market that you need to pay a big number to get certain kinds of deposits, you can pay whatever number you need to pay and whatever number makes sense for your bank to pay. If you're in a low market environment and you can get away with paying 100 or 125 or 50 or some lower number, if that's what makes sense to the client, you have that ability. But on a send-only basis, the yield is going to be pretty attractive to you, and then you can pass along as much yield as you want to your clients to make sure that it makes sense to them from an investment perspective. Now, one of the critical things about using a program like this is integration. So DDM is integrated through effectively all of the core processors. FIS, Fiserv, Jack Henry, and others. All of these have different systems within the company, so there are a lot of different types of integration, but we are broadly integrated with all of the major core banking system providers. Additionally, on the trust and accounting side, so a lot of banks will have some type of a trust department, asset management department that manages money for high net worth individuals or for not-for-profits, corporations, whatever it might be. In general, that group is normally sending money out to money funds for its cash balances within those accounts. It's normal that a wealth management will have anywhere from 3 to 10% of their money will be in cash. That's money that the bank as a whole has worked very hard to get its arms around as an asset management business. But that's money that's leaving the firm and going to Federated. That's money that's going to Fidelity. That's money that's leaving the balance sheet of the bank. And with a program like this, this is a way that you can get access to that money. But to do so, you need to be integrated. We're integrated with all of the major trust and accounting systems so that it can be seamless for your trust department to use the program, and you have the ability to get those deposits back on your balance sheet in terms of reciprocal deposits. So I wanted to talk quickly about what does integration in a core banking system really mean? How does it work? Things of that nature. Basically, what will happen, and again, there are a lot of different systems, so that the details are different in every system. But basically what happens is you will go into the core banking system, set a peg balance for an account that really that peg balance is determined based upon what that client's activity is over time. So if you've got a client that regularly moves millions of dollars, you might set the peg balance at $4 million and $2 million. If they go above $4 million, sweep money out of the program, sweep money out of the checking account into the program. If they go under $2 million, reverse it and bring it back into the account. The way that works is the core banking system will actually create a transaction to pull money out of a customer's account based upon the rules that you've set in that system. So if a client, in that example I used, if a client's got $6 million, the core banking system will go in and remove $2 million and send it to us. If that client's got $1 million, they will remove $1 million from us and put it back into their checking account. So the core banking system creates transactions on a nightly basis by analyzing the account balances versus what you have put in the system as far as a peg balance. clients will have access to all of their funds every day, but that money will be FDIC insured. And again, this is important because this will, in many cases, allow you to access large customers that you may not have been able to access before. Now, the same thing is important on the trust accounting systems in your wealth management or trust department businesses. This becomes a sweep vehicle. The DDM program will become a sweep vehicle. Within those accounts, any idle cash, that 3 to 10% that sits in idle cash for most accounts, will sweep into this program. We'll send it out to banks and make sure that that money is fully FDIC insured, and then reciprocate back to you to the extent that the bank wants money reciprocated back to them, just as if the money was coming out of what we describe as the brick and mortar side of the bank. So if a trust department sends in $100 million, you can take 100 back, you can take 60 back, you can take 40 back, you can take whatever number back that you want. We will pay that trust department a rate, and that rate, which is determined between you and the trust department, will be the cost, the broad cost of funding that you have. But again, the important thing here is that these are deposits that are normally out of the reach of most banks from a due diligence perspective. Most customers do not want to pay a fee to their wealth manager only to have that money then turned over to the bank that they're paying the fee to. In this situation, this would be money that would be going to third-party banks. The rate would be very attractive relative to other options of similar types. Customers that are working with trust departments at banks will generally understand FDIC insurance very well. So it's kind of a win-win situation for everybody. So as an overview, and then I see we have some questions. We'll get to some questions in a few minutes. The key thing here is that with the passage of the regulatory reform bill, reciprocal deposits should now be able to fit into any core funding strategies. They remain as core deposits. They are not broker deposits. You can do so for a very large, if one thinks about it, 20% of a balance sheet is a very big number. But while that number is large, it's going to come from as diversified a group of customers as you want. So you can use this for municipal customers and individuals and trust customers and any other kinds of customers that you can think of. So you can have a diversified source of funding up to 20%. Now you can do more than 20%, but if you do go over 20%, the amounts over 20% would have to be considered brokered. This program offers $25 million in FDIC insurance per tax ID. On a one-off basis, we can go up to 30, or in some cases as high as 35 million. That would be 50 million or more for joint holders, and it can be used just like every other account at your bank. Each type of an account would get separate FDIC insurance. So somebody's IRA would get insurance separate from somebody's individual, separate from somebody's joint account. Same rules would apply to our program as would apply to standard accounts that you have in the bank. The program can be used as a sweep option for core customers through DDA sweep functionality, or it can be used as a position traded for large customers that just want to park money but want liquidity. It can be done in either way. And here is something I think that is really starting to gain access. It really can be used in the trust and wealth management businesses to get access to new deposits that a bank didn't have access to before. So with that, just before, I just want to thank again everybody for the time today. With that, I will turn it back to Janine for some questions.
Great, Tom, because we do have a lot of questions. I'm going to start here, though. What paperwork does our client need to sign to enter the program?
So one of the attractive things here is that your client doesn't need to sign any paperwork with us. Your client doesn't contract in any way, shape, or form with us. Through the contracting process, all we need, in layman's terms, all we need from that perspective is for you to say that you have the authority to act on behalf of your customer. So what this means is that you can determine what is the best way to contract with your customer. It can be part of a bundle with all of the other agreements that you give a bank for different kinds of accounts or different kinds of a service. It could be done as a standalone. We provide you with samples of what we think makes sense as far as information to provide to the client, but that is completely under your discretion on how you contract with the end client, as long as you tell us that you have, in fact, received authority and contracted with the end client.
Okay. What if a bank needs to increase deposits? What is the process?
So the process there is as simple as a phone call or an email or something of that nature. All you need to do is call us. I mean, assuming that we have contracts in place for taking deposits, all you need to do is call us or send an email to a group email address, or you'll have a specific person that will also work with you. That's all you need to do. All you need to do is call us and say, I need $15 million. What can you do for me? Same thing if you're a reciprocal customer and you've put $100 million into the program and you want to go from $100 million in reciprocal down to 75, you would simply contact us by phone or email and say, I want to go from 100 down to 75. I want to do it by the end of the quarter. I want to do it by the end of the week, the end of the month. Can we do it tomorrow? Whatever it is that makes sense for you, that's all you need to do to contact us, and we will immediately let you know the timing of when we'll provide you with the funding or the reduction in funding.
Great. Okay, here is one that asks, why is the customer not limited to transactions, the money that they can put into, like, say, a money market or savings? Why aren't they limited here?
So the money that we send out is primarily sent to DDAs. Some of it is sent to MMDAs. So the vast majority of relationships we have are with unlimited DDA transactions. Now, if somebody's got a money market account on your side and you need to limit the transactions that they can place as far as withdrawals, that is a separate issue. But as far as the money that comes into the program, they can withdraw money on an unlimited basis, and that's largely because of the fact that we have so many DDA accounts that we use as opposed to MMDA accounts. Great.
So on Reciprocal, what determines rate on the balances sent back to the sending bank?
The only thing that determines it is the rate that you pay to your clients. So at the end of the day, if you have, the simplest format is to use a single customer. If you have a single customer that's putting in $10 million and you're paying that customer 90 basis points, your cost of funding will be 100 basis points. Now, there will be accounting transactions because you need to guarantee the interest that's being paid to all of the other customers. All the other banks need to guarantee the interest that's being paid to yours. But at the end of the day, the rate that you're getting on all of the balances is going to be the rate that you pay your customer plus a fee.
Got it. And with that, because you touched on this, I'm just going to jump down here so you can clarify. Are there any fees to Rich and Tang outside the 10 basis points?
No, there are no other fees.
Okay. Are receive-only deposits considered brokered?
Yes, as a general statement, most, yeah, I would want everybody to consider to consult their own regulatory and legal people, but we would not advise anybody that they should treat receive-only deposits as core deposits.
Gotcha. Would you please explain the 20% or more funds that then they're considered brokered? And if you don't mind, because it seems this person might have missed that section. So without too much detail. But
So, yep, quickly. So basically, under the Senate reform, under the regulatory reform bill, that bill says that a bank can have 20% of their assets placed in reciprocal deposits and consider them as core. It does not place a limit on the amount that a bank can do in reciprocal, but they can only treat 20% as core. So if you have 21% of your assets in reciprocal deposits, 20% would be core, 1% would have to be treated as a brokered deposit.
great. Okay, so does Rich and Tang offer a CD option?
We are in the process of rolling out a CD product that we'll have later this year. At this point, we do not, but we will have one later this year.
Okay. Are there any limits on what rates we can pay our customers?
There aren't. Again, at Fed funds is at 240 now. You can pay your customer 5 basis points. You can pay your customer 300 basis points. You can pay them 500 basis points if you want to. I certainly don't know why you would, but there is no limitation on the rate that you can pay your clients.
Okay, going to jump here, Tom. Are there any limits on the types of accounts that can use reciprocal deposits? I think you might have touched on this, but
no, there isn't. This can be used for all, any kind of a customer that you can open up an account for on your bank, at your bank, excuse me. You can allow into this. We will take into this program, and we can allow. Quite frankly, the only accounts at this point really that we can't take in, for instance, is we can't take in cannabis money, things of that nature. Money that you would struggle to take in yourself or not be able to take in, the same rules would apply with us.
okay, so we actually have more than one question on this. So without mentioning names, just want to give you the opportunity, because these questions relate to how is this program better than XYZ's program. Do you want to comment on that?
Sure. So I see somebody's asking specifically about Cedars. I mean, the big difference between us and Cedars is that our program is fully liquid. Cedars is a term product. This is a fully liquid product. I think the differences for us are in the integration structure that we have with most firms. Is a little stronger. Our statementing process is considered by many to be stronger. But the products that are offered are similar. We just obviously think that there are strengths that we've focused on very hard. The other thing that many are starting to look at is to make sure that they have two providers as this product becomes increasingly important to many banks as more of a core strategy. This is becoming less and less of a ancillary strategy and more of a core strategy. We see a lot of firms looking for a second provider to make sure that they have backup, like they would with any product that becomes an important requirement.
Great. If when using reciprocal, I pay my customer 1.5%, can I get reciprocal deposits at a higher rate? And
I'm not sure I fully understand that, but at the end of the day, if you pay your customer $150, your cost of funding will be 160 because it'll be the 150, and you would pay us 160. And really, I think that's the part to focus on. Now, there could be customers that are being paid a higher interest rate at their own bank, but at the end of the day, that is money that will be paid by that bank. There'll be some accounting entries that will change those numbers, but at the end of the day, your cost of funding is absolutely going to be 150 plus the fee.
Fabulous. Wow. So much great information here. If we didn't get to your question, just know that someone will reach out to you via email with an answer. And I just want to thank everyone for attending today's webinar, but more importantly for your participation in the form of your really great questions. So I'm hoping that in the near future we can bring Tom back to go into this, answer even more of your questions and discuss this even further. So be on the lookout for that as I twist Tom's arm. Also want to thank you, Tom, for sharing your expertise with us today. And later this week, watch for a follow-up email containing a link to the recording of today's webinar. That concludes our webinar. Thanks again. Have a great day.